Hi, good evening all. Thanks for joining us on time once again. We're just going to give it a couple of moments before we kickstart the session. So do take this time to also invite those of your friends who might be keen to join us as well. We project to start in about 3 minutes time. So we'll see you shortly. Hi, a very good evening, everyone. We will be starting our session now. So once again, thanks for joining us here today in the final installment of the CF Discovery series. Now, just to quickly recap what we have done or what we have shared in the first two series. So we talked about introduction to CFDs. What is it? What does it include? What is the trading mechanics for CFDs, right? Subsequently, in the second session, my colleague Junkit also shared about what's the difference between shares and also share CFD, and what are the risks involved. So in this final series today, we will be sharing with you how to create your very own trading plan. So this portion of it is vital. It links everything that you have heard so far into one concise plan to get you started. So do stay till the end of it, where we will review how does a trading plan statement looks like, so that you can kickstart your very own crafting of a trading plan. Without further ado, let me proceed. So before I begin in this session, before I proceed further, I just want to share today a quick disclaimer that whatever will be shared in today's session does not take into account your trading appetite or your risk appetite. So if you do wish to trade, do perform your due diligence and seek a investment consultant. So with that, I will begin. Quick topics that we'll be covering today. I'll be going through what is a trading plan exactly, what is risk management, what are the three key elements of a trading rules, and what is this thing called a post-trade management, right? Where we'll talk a little bit more after placing a trade. Is there anything else that you can do to manage that trade? And as I mentioned, last but not least, at the end of the session, I will cover what does a complete trading plan statement looks like for you, so that you can craft your very own one. Okay, so what exactly is a trading plan? I think for many of us, we are familiar with what plans are generally, right? We have work plans, we have travel plans, which was more frequent 2 years back, right, when we could travel freely. So hopefully this is something that we can do shortly. And then there's also fitness plan. Now, the objective of a plan obviously is for us to identify what our goals are and where do we intend to reach, and how can we go about doing it. So in short, that's a plan. And the funny thing is, for these different aspects of our life, we plan for it because we know that it is required, right, to give us a clear picture of how to go about doing it, our approach, and where do we want to achieve. But for something as important as trading, right, for many of us, when we approach it, there is no plan we have in mind. So we kind of approach the market in a very arbitrary manner. So it is likened to say that you just buy a plane ticket to a country without any itinerary. So that is the equivalent. So that would be crazy, right? Especially for something as important as trading. So it is extremely vital. It is extremely key in your process of starting your trading journey. So what exactly is a trading plan? Right? It is an A to Z of things you need to do to achieve an objective. So in this case, in trading, it is to be consistently profitable, right? I assume that that is the case. No one wants to be unprofitable. So that's the key objective that we are all looking for. And I think not just profitable, but as consistently profitable as possible, right? So that is key, because you can win one big trade and have many consistent losses that will eventually take you out of the trading game. So that is key. So secondly, it is a checklist of conditions that has to be fulfilled in order for you to take action. Now, this is the crux of what we're sharing today. Exactly what are the conditions that you need to fix your eyes on, or you need to craft in your trading plan before you pull the trigger. And last but not least, it is a clear definition of the parameters within a strategy, right? So again, why is it important? It helps you to identify which strategy works and which does not. I mean, because there are so many strategies that you can easily find on the internet, right? Pullback strategy, breakout strategies, momentum strategies, trend following strategies. So many out there. How do you know which one works? And it is not a one size fits all. So what strategy works for one person may not necessarily work for you in that manner, especially when we are talking about discretionary trading, right? So it helps you to maintain an edge. So secondly, it's important because it keeps you from trading inconsistently and relying on your gut, right? So I can't see you over there, but if we were in a physical setting, I would love to see a raise of hand of how many of you who have started trading, right? Whenever you enter a trade, it is based on a gut feeling. There is no basis to back up why you enter the trade. You just look at the chart and you feel like, hey, maybe it's a good time to enter because perhaps price is at a very low point or price is at a very high point. And last but not least, it manages your emotions in trading. And this aspect is especially key. I don't know you have heard this phrase before, cut your losses quickly and let your winners run. So more often than not, it is the reverse that happens, right? Where people cut their wins quickly in order to seal in the profit that they have, and they let their losers run because they are banking on the chance that there will be a reversal and that their losses will turn to break even and eventually a profit. So if you have been trading, I think you are quite familiar with what I'm talking about, because this is something that everyone who started their journey is subjected to, trading psychology. Right. So what are the components of a trading plan? Right. So four key portions. One of them is position sizing. How much should you be putting in each trade? How should you think about it? Right. Our entry rules. When do you pull the trigger to enter the market? So what must happen before that happens? Right. And exit rules. When do you exit, either to take a loss or to take a profit? And last but not least, position management, where you think about after putting on a trade, how can you manage this position, either to maximize profit or to minimize losses. So I will go through a couple of scenarios when it comes to position management. Right. So when we think about risk management, right, I don't know how many of you ask yourself this question. Is it a question of how much am I willing to risk per trade? Right? The answer is no. It shouldn't be a question of how much are you willing, but instead it should be a matter of how much should you be risking per trade. Now, let me break this down a bit clearer so that you understand where I'm coming from. So it seems like these two questions are quite similar, but in fact there are differences to it. Why do I say so? Right, because there is actually a logical approach in calculating your risk. So this is what I'm trying to uncover in this session. So if you can, if you want, if you like to participate, in this question, do comment in the chat box what you think the answer is for this question, right? So you have a total equity balance of 50,000. So how much should you be aiming to risk per trade? Would it be a fixed amount of $2,000, or B, whatever amount you feel confident of? The more confident, the larger your trade amount. Or C, 1 to 2% of your trading account balance. Right? I think for most of us here, we understand that the option is not B. Right? So if your selection is B, that's a warning sign, right, of how you are thinking about risk management. So it is between A and C. So my answer today is C, right? 1 to 2% of your account balance, not a fixed amount, because that would vary from your account size, right? If you're trading a $1,000 account, a fixed amount of 2,000 would not really work out. I would explain a bit more why later. So 1 to 2% of your account balance per trade is something that is sensible, something that can be used as a guideline whenever you're looking to take on a trade. So this is the portion where it covers about position sizing, right? How much do you put on per trade? So why does that work? Why do I say 1 to 2% of your equity balance? Now, the reason for that is because of this principle called the law of large numbers. Right? What does it mean? It means that as the sample size increases, the average results of this sample size get closer to the expected outcome. So in fact, I have included a photo of a roulette table, right? And in trading, in the casino, this is something that they use to have an edge over the players. Because if you notice, there is a certain, it seems like there is an even number of red and black. But what you may not notice is there is also a green pocket, pocket zero, where if the ball lands into, would also cause you to lose. So in that sense, they don't have a 50-50% chance, but they actually have a added percentage of chance to win against you. And maybe in the short run, yes, in a matter of 1 to 2 bets, you could win. But in the long run, the casino will gain the results that match to the yield that they have or the edge that they have, which is above 50%. So that's kind of the trick that they use. And that is what we aim to do in trading, right? To have that edge in the market so that over the long span of time, the results will move towards what the expected outcome is. So what has this got to do with us traders, right? So the more we trade using the same strategy, the more the outcome will move towards the winning probability. So let's say today that you are trading a 50% win rate strategy, sorry, a 60% win rate strategy, right? Logically, it makes sense that out of 10 trades, 6 of them will be winners. But now, the thing with trading is that it is a probability game. It is not necessary that within the first 10 trades, you will win 6. Right? It could be after a string of losses, then your string of wins come. But you must allow the total number of trades to add up in order for you to see the results. So as in the example I've given, for example, if you have a 60% win rate trading strategy and you were to risk 20% of your trade, 20% of your balance per trade, what happens is that at the end of the fifth trade, you would have completely blown your account and you would not have gotten to the phase where you start to see the wins, right? So this is the law of large numbers. So second principle that I want to highlight is risk to reward ratio, right? And this really talks about every time we place money on a trade, we are looking to make more out of the amount that we risk, right? How much more. So I thought that the image was pretty cute, and I think it is quite self-explanatory. The cheese is the reward, but the mouse trap is the risk, right? So the mouse has to contemplate whether or not to go for the cheese. Is the reward worth the risk of the mouse trap shutting down on him? So that's kind of the mindset that we have to carry whenever we put on a trade in terms of risk to reward ratio. So an example, if I'm risking a total of 500 per trade, I should be looking at the possibility of making above $750. Now, the reason for that is because my risk to reward now is 1.5 to 1, or rather 1 is to 1.5, my bad. So even if your winning rate is 50%, you know that over the long run, the amount of wins that you have, the amount of money that you, the amount of profit that you collect from your wins will far outweigh your risk. So in that sense, even with a 50% win rate, overall, you will be making profits and be consistently profitable, right? So this is just a general guideline. Whenever you look to take on a trade, you should be looking at a risk to reward ratio above 1.5. Right. So we've covered a summary of what the various risk management concepts are. Right? The question to ask yourself when putting on a trade is really not about how much you are willing to risk, but more so how much should you be risking. Right? So that's the question you should be asking yourself. Measuring risk, right? So you should only risk 1 to 2% of your account balance. Remember the principles of the law of large numbers. And last but not least, your risk to reward ratio. Now, so if you have this in mind, each time that you place on a trade, you would have grasped a very good concepts of risk management. Now, so we are moving on to the elements of trading rules, right? So there are 3 key ones that I would like to talk about. So first one would be the overall trend. to find out what the trend in the market is like right now. Is it upwards? Is it downwards? Or is it ranging, which is sideways market? So what are some of the buying and selling zones? Right? Where are the key areas of value? So for those of you who do not know what support and resistance are, when you look at a chart, a pricing chart, you notice that there are always areas where price tends to come into and move away from. So those are zones where we call buying and selling zones, where buyers and sellers tend to interact at that level. So you want to make sure that within the consideration of your trading rules, there are buying and selling zones. Last but not least, you would want a confirmation trigger. So what are some signs to look out for that signals a trading entry? Right. So very quickly hopping into key element number one, the trend is your friend. What does this mean? Right. It means simply that whenever you take on a trade, you want to look at what the overall trend of the market in the product you are trading. If it is an uptrend, you want to be looking to go long. If it is a downtrend, you want to be looking to go short, because more often than not, price will continue in its dominant trend until a major reversal comes. But before that reversal comes, it is more likely than not, prices will continue to move in the trend it is dominant in. So how can you identify what are the dominant trends that I've spoken about, right? So the first tool that I would like to share with you is actually through the use of a moving average or multiple moving averages. So when applying exponential moving average, you can tell, right, what if prices are above the moving average, then you know that it is an uptrend. If prices are below the moving average, then you know that it is on a downtrend. So the next question will be, what are some common moving averages you would like to apply, right? So as a rule of thumb, 200 moving average tracks long-term trends. So you know when you put on the 200 moving average, you can tell if price is above it. In the long term, it is on an uptrend, right? So 50 moving average is the medium-term trend, and 20 moving average is the short-term trend. So generally, these are the numbers and the moving average you want to use to determine what the trend is of the current market. Right. So if your moving average is pointing upwards and price is above it, it is taken to be an uptrend. So that is how you determine what trend is the prices are at this point. And the reverse is also true. If the EMA is pointing downwards and prices are below it, it is taken to be a downtrend. So I just give you an example over here. So at this point in time, moving average is pointing upwards, right? We're using the 200 moving average here, and prices are above it. So in this portion of the chart, you can take it to be in an uptrend. But you notice something has happened. So price broke below the moving average, and the moving average starts to slope downwards. And that's when the trend has changed, right, into a downtrend. So the moving average is a good tool for you to identify that. So yeah, the question there posted, if it's uptrend or downtrend, I think I've just gone through that as well. So number two is through the use of trend lines. So what you usually want to do when determining trends is determining trends on a higher time frame. So if you are trading on a intraday time frame, right, you want to be looking at the 1 day time frame or the 4-hourly time frame. So this will give you a better idea of what the bigger picture of the market structure is like. If in the higher time frame, the markets are in the uptrend, then you know I should be looking to take long trades. If the reverse is true, if markets in the higher time frame is in a downtrend, then you want to be looking at taking short trades. So trend lines essentially is using a line to connect 3 or more points that are consecutively higher. So 3 higher lows. So in this chart example, this will be point number 1, point number 2, and this is point number 3. So you can notice this is a straight line that is pointing up, and that is where you know that you have an uptrend. So secondly, if you notice on the charts there are 3 consecutive lower highs where you can connect with a straight line that would form the downtrend. Yeah, so in this image is clearly an uptrend because you can see that the line actually connects 3 lower highs and price are moving higher. So this is the second way to determine what the dominant trends are. So first lesson, trade with the trend. That's what I would recommend. Unless a major reversal happens, price will tend to follow in the existing major trend. So once the trend is identified, look to only take positions that follows the trend. So these are the lessons that I have iterated throughout this portion of. Yep, apologies. I just had technical error there. But the second key lesson that I want to share about is buying and selling zones. So basically what that is, as I mentioned, is an area where buyer and seller tends to act, right? So you're searching for areas of value to enter a trade. So what are some tools for you to identify value zones or buying and selling zones? So one way is through the use of channels. So previously when we're talking about trends, I mentioned the use of a trend line, right? So essentially, if you were to break this down, you notice that for this portion, the top line forms a trend line for a downtrend because it connected 1 point, 2 point, and 3 point. So what makes a channel is simply on the opposite side, you also include a line that is parallel to the first trend line, and you manage to capture prices within this area. So essentially that is what forms a channel. So in the same example below, you can notice 1 point has touched, 2 points, 3 points, 4 points, straight line. On the opposite side of it, there is also a parallel line that is straight, which captures price within the area. So this is what you would call a ascending channel, and this is what you would call a descending channel. So basically, these are areas of value you want to identify because you notice that whenever price touch either one of these lines, it tends to bounce away from it, right? So just giving the example here, when prices came to touch the bottom resistance, it bounced off. Second time, third time, and when it comes here, fourth time and fifth time. So what it indicates to you is that when prices come to this region, they will likely reverse. So that is what it is trying to indicate and what you can interpret from support and resistance in a channel. So second one is through the use of a horizontal lines. So whenever you are able to connect horizontal lines, connecting 2 or more coinciding points on the chart, right? This will form your support. Of course, there's no hard and fast rule to say that, oh, is it? Some people will say that, oh, 3 points is the best. Some people say more points are the best, but generally, as a rule of thumb, more than 2 points. For the best effect, usually what you want to see is 3 or more. Right, so I have outlined what support looks like in the horizontal line. So over here, you can see price coming, touch once, touch twice, connected by the horizontal line, that's one. So over here, you can see I circled first point, second point, third point. So this forms another resistance or support. 1, 2, 3, 4. So where price coincides within the horizontal line. So now, the exception is that when prices reach its highest or lowest point and reverse, it also becomes a support or resistance. Now, so of course, the highest point would be a resistance, lowest point will be a support. The reason for that is because once it reverses and price comes back to the region again, it is likely that sellers or buyers will tend to react at this region, causing it to be a potential point of support or resistance. Now, Moving averages are also an extremely good tool at identifying value zones. So as I shared, the common number is 50, 100, 200, right? So what do I mean by value zones, right? So if you take a look at the charts, you notice that there are certain moving averages which prices respect. So what do I mean by respect? I mean price goes to the area and it reverses from there. So now let's take the example of the bottom image. So the red line, I believe that this is labeled wrongly. The red line here should be 50 EMA in this instance. So it came here, it touches, it rejects. Second time, it rejects. Third time, almost reaching the 50 EMA, it rejects lower. So of course, this portion, it broke away. And then subsequently, it came back and it respects the 50 EMA. So what you can say is that, hey, the 50 EMA is really a strong point or a strong resistance where once price approaches the level, it tends to reverse. So that is how you kind of use multiple moving averages to tell you what are the area of values. So lesson 2, building on top of lesson 1, trading with the trends. If it's an uptrend, you look to long, downtrend, you look to short. Before you enter a position, you want to look for areas of value. So areas of value, as I mentioned, can be found in the form of channels, can be found in the form of horizontal lines, can be found in the form of trend moving averages. So of course, these are just a few ways and tools to identify what areas of value are. In fact, there are many other ways, right? These are non-exhaustive. If you like to use Fibonacci retracements, if you like to use Fibonacci fans, right? These are areas that helps you to identify, but I won't go too deep into that. As a start, I think these are good tools which you can experiment with and identify areas of value. So I would like to encourage you, if you don't already have a demo account, do download them and try and play around with the charts and identify what are some areas of value. Practice how do you identify trend. Now, I'm going into the final portion, and this is the portion that gets most beginner traders excited, right? Because they feel that, hey, if I find a right entry confirmation trigger, I would have found the holy grail for trading. And this is the trap, in fact, that many new traders fall into, where they feel that, oh, a certain indicator, right, would best tell them when to enter the markets. I don't know if you have heard before, some people swear by stochastics oscillator. Some people swear by RSI, and they feel that that is the key indicator which tells them to enter a market accurately. But here's the sad truth, right? You can never use a confirmation trigger on its own, right? Let me give you a very quick example. For example, if the market is right now on a uptrend and your stochastics oscillator gives you an indication that markets are oversold, you are more highly likely to enter a trade on the wrong side if you were to go short, because as I mentioned, the principle of trading with the trend is prices tend to move in tandem with the trend. So what you may find happening is that price reverses very quickly, it goes down and it moves back up again according to the uptrend. So you can't use indicators or areas of value in isolation. This is something that we emphasize time and time again, that you do have to use a combination of different signals in the market. So one of them is trend, second is areas of value, and third, confirmation trigger. So only when you find a confluence of factors, meaning to say that all these three factors agree with each other, then it is the time for you to enter a trade. So in this section, I just want to teach you what are some signs to read when to enter a trade. Right. So oscillator, one of my favorites. Basically, what is an oscillator? It is a technical indicator. So if you're familiar with trading platform, you would know what a technical indicator is. Basically, there are mathematical equations that count how does price behave historically and gives you two extremes, right? One of which is price is overbought, one of which price is oversold. So this gives you kind of a snapshot in the market right now if price is overheated or price has been too cool. So again, it is to be used in conjunction with other tools to affirm its projected direction. So what are the two most common oscillators that I am aware of personally? MACD and RSI. Right, so I'll go deeper into how you use them and how you can interpret signals. So MACD, short for moving average convergence divergence, is a mouthful, right? So this indicator has two main components. One of them is the MACD line and the signal histogram, at least for MetaTrader 5, right, our platform. So when you look at it and you think about it, the best representation is really like an arm wrestling match. It helps you identify what is the strength of the current market and what is the price momentum in a certain direction. Now, why do I parallel this with arm wrestling? So you are able to identify who is the stronger arm wrestler simply by whose hand is leaning closer to the table, right? Or rather, whose hand is further away from touching the table. Then you know that that contender is stronger. Now, how do you identify momentum? That will be how quickly the stronger arm wrestler brings his opponent hand down to touch the table. So if he brings it very quickly, that will be a strong price momentum. Right, so in the same way, this is what the indicator tries to share with you and relate to pricing. So there are two ways that you can in fact use the MACD indicator. So one way I would like you to focus is on the rectangle area over here at the bottom. So when the MACD line, so which is this red dotted line, I hope you can see it, and the signal histogram, which is the vertical line which are grayed out, is above the zero line. So zero level is over here, right, on the right hand side. When it is above the zero line, it is in fact where the bulls are stronger than the bears. So which means to say that price are more likely to move upwards. So that is what I mean by a bull stronger than bears. And when the converse is true, where both signal histogram and also the MACD line is below the zero line, it is likely that bears are stronger than the bulls. So price tend to move below. So you can look at the illustration right over here that when prices are above the zero line, when MACD and the signal histogram are above the zero line, prices move up. And when it's below, then prices are low. But there's a second way to use the MACD indicator where I mentioned price momentum is involved. If, even though it is above zero line, but the signal histogram is lower than the signal line, right? Then that will indicate to you that momentum is falling, even though it is bullish as seen on the left-hand side of the chart, it is starting to lose bullish momentum. So that is where price will tend to reverse. So that is one example, two examples of how you use the MACD indicator. So one is with reference to the zero line, right? Simply, is it above or is it below? Secondly is the MACD line with reference to the signal histogram. So that is how you tell whether the strength of the price is there and momentum of it. So RSI. To put simply, RSI is like a speedometer. It tells you how fast is price changing over a certain period of time, and it identifies overbought and oversold conditions. So much like a speedometer, if you're going at 90 and your speedometer tells you in the next moment you're at 110, you would have accelerated by 20 kilometers per hour within that span of time. So that's what it's trying to indicate to you, and it helps you to measure speed of change. So there are two very clear levels for RSI. Again, I point your attention to the bottom third of this image. When prices are approaching the level of 70, it is indicative that prices are overbought. So when prices are overbought, the scenario is that price is likely to reverse lower. So when prices are at the 30 level, you will note that it is oversold, so prices are likely to reverse higher from there now. But again, to illustrate my point that this can't be used alone, you notice that the current trend of this chart is in a downtrend, right? No need to dispute or pull out the moving average. It is quite evident and clear that there are lower highs and lower lows being formed. So this is indicative of a downtrend. Now, when you look at the indicator and see that it is overbought, it means price is likely to reverse lower. And in the context of a downtrend, as I mentioned, price are likely to move lower as well. So when there's a combination of these two factors, you see indeed price went lower. Now, when you look at it at the context of an oversold condition, by right, what the indicator is telling you is that, hey, it's time for price to reverse higher. So it did, but it had an extremely short run over here before price continued to move lower. So it is why, again, it is so important to read these indicators in tandem with what the overlying trend is and what are the areas of value. Now, second way for confirmation trigger would be a moving average crossover. So this is one that is extremely common, and I think one that you may have learned about when you browse technical analysis tricks and tips, right? This is one of the first things that you might come across. So when the shorter EMA, a 50-period EMA crosses above or below the longer period EMA, which is 100 in this case, prices tend to move in the direction of the faster EMA. So in this case over here, you see 50 crossed above the 100 EMA in green, and prices moved above and started to trend higher. So the reverse is also true when the 50 EMA crosses below the longer term EMA. What happens is that price broke below and started to move in a downtrend manner. So this is another confirmation trigger that you can take. Now, so I've covered a bit about confirmation triggers. So the key thing is to identify key factors like price momentum, overbought, oversold conditions to increase the probability of your successful trade. But once again, I emphasize it's not to be used in isolation, but in conjunction with both the trend and areas of value. Now, so with all of that in mind, let's say you have found a chart that is in an uptrend, right? Long-term uptrend, price rests above 200 EMA. Secondly, you notice that price is now resting on a support. And you notice that either using indicators or other things such as candlestick patterns, chart patterns as your confirmation trigger, that it is giving you an indication you should go long. So all stars have aligned, you entered the trade, right? So what do you usually do at this point? Right, I would love to hear the responses. What I usually get at this point in time is that, I don't do anything. I just let my trade run, right? And until a point where I become uncomfortable with the losses or I am happy with the profits, then I would close the trade, right? Or the worst case scenario, right, for some of us is we allow the account to be blown. Then we let it naturally take us out of the trade. So that's the worst case scenario. But here I am today, I want to share with you a couple of scenarios which you can use to manage your trade after placing it. So here are a few tips in post-trade management where you can reduce the amount of losses by being stopped out. You can capture earnings even when your trade misses your take profit level. And last but not least, you can capture earnings when you are uncertain where to take profit. I'll be covering a couple of scenarios. I hope that it is relatable to you and you have chanced it before, because only then you will understand the frustration of that feeling whenever you encounter those scenarios, right? So scenario number one, you place the trade, price moves slightly in your favor, and then it dives the other way completely, triggering your stop loss. So what started out as a profitable trade that moved in accordance to the direction which you projected quickly reversed and took you out. So you might be thinking to yourself, I wish I hadn't been taken out by a stop loss. So one tip for you after placing in the trade is if you notice that your trade is sufficiently profitable where price has moved past your entry level by quite a fair bit. Now, quite a fair bit is subjective is in here. It is difficult to determine. That is based on discretion and over time, right, of trading. Then would you be able to roughly estimate what is that level for you? So it's different from everyone. What you could do is actually move your stop loss to break even, right? So up your entry point. So what happens at this point if trade were to reverse? You would have broken even, no losses to you, because then your stop loss would have been moved up to your break even point. Right. So, but the caution here is that by moving it too early into your entry level, you don't allow the trade to play out. So short-term volatility may take you out prematurely, and you find the market move in your projected direction. Then you will come to regret it and say, maybe I shouldn't have moved it too early. So this is a tip, but also a word of caution that you might want to allow your trade to run in the profits for quite a bit before you move it to the break even. So second tip for post-trade management is that you enter a trade, you have a take profit level of 30 pips. I'm using the example of Forex, right? Or even for, if you were to look in the context of shares CFD, for example, you have a profit target of Tesla at $1,100, right? You entered the trade at $1,000, and price moved to $1,095 and it reversed. So in this scenario, it is very similar in the context of Forex, where it almost reached your price target, but prices reversed. So then what can you do in this scenario in order to capture some profits and not take a loss? So what you can do is effectively to throw your stop loss past break even into profits once your trade has moved sufficiently deep in the money. So what do I mean by that? In the first scenario, right, price started moving in your favor and it moved slightly in your favor. You move your stop loss to break even where your entry is. Now, we're talking about a scenario where price is almost at your take profit level. So what you want to do is to move that stop loss even further in, so that if at any point in time price reverses, right, you would have been able to capture some profits. Now, then the next question will be, how much do I know to move my stop loss in the money? There's no straight cut answer to this. Again, there's no one size fits all, but a rule of thumb is always to move it towards relevant support and resistance. So taking, for example, you are going long on a trade, so which means you bought into the trade, right? And you notice that when price moves, it likely does not move in one straight line. There are ebbs and flows to it. So you might want to place your stop loss and trail it against the previous low. So that's how you move it up accordingly. So price moves up, comes down, moves up again, then you move your stop loss below the previous low that was just established. So this is one tip. But again, a word of caution, if you were to move your stop loss too closely, your trade may be closed up due to volatility. And a second scenario may be the case where even though a deep correction might happen, right, it might eventually turn over and hit your profit level. So really, in discretionary trading, is about how you want to manage your trade. So these are some tips for you. So scenario 3, all conditions have been met, you take a trade, but you feel that despite putting a take profit level at, using back the example of Tesla, right? You entered the trade at $1,000. You think that the take profit level could be $1,100, but maybe there is a potential that it could go up to $1,500 or $2,000. So what do you do then? Because if you were to leave your stop loss at 1,100 and price moves higher beyond that, you would have lost that potential profit, right? So what you can essentially do in this scenario is to not put a take profit level, but rather to keep trailing your stop loss further and further and further until prices eventually reverse. So this post-trade management move here is really to capture a big move in the market, right? An explosive move that you foresee with no take profit level in mind. Perhaps it is the starting of an uptrend, or something explosive is about to happen for that particular counter. So you don't have a particular profit in mind or particular level which you want to cash out. So this is a tip for you to take whenever you are managing a trade like this. So again, caution, as with the previous scenario, what can happen is that if you throw your stops too closely, what may happen is that your trade will get stopped out due to short-term volatility. And the other scenario is your trade moves in your favor, a deep correction happens, but not deep enough to take you out in your stop loss and then reverses and move in your favor again. So this is the scenario that you do need to watch out for. But all that being said, I think these are just some tips and tricks for you to manage your positions and to not go through that frustration. If you have been facing frustration of whatever scenarios I've mentioned, these are some tips for you to take note of. Okay, so as I mentioned, I think the best way to go about doing this is really to have a MT5 platform. In the previous series, my colleague Junkit has went through with that. So I will not take the time again to go through this platform demonstration. What I will highly encourage you to do is to scan the QR code, a request for a demo account, right? When you scan the QR code and you fill in your details, right, what happens is that we will immediately send you an email giving you your login ID and password. Now, in the email, we also give you the download link for MetaTrader 5. So you do have to go ahead and download that into your desktop. If you are a mobile user, that's fine as well. You can go to the App Store, the Google Play Store, and download MetaTrader 5, and then input, very importantly, the ID, the password, and the server that has been allocated to you. So once that's done, you can actually play around with the indicators. You can perform this assignment on your own, right, to identify what the trend is, what are the support and resistance in the market using tools like trend lines, moving averages, and you can start to spot for what confirmation triggers are. And then from there, perform a testing by entering a demo trade, right? Because at this point, you are not risking live money, so the stakes are not as high. But the idea is to get you in the momentum of having good habits before you execute your trade. Because chances are, if you cannot perform trade according to your rules during a demo account, you are not likely to do it in a live account as well when you're dealing with real money. So once again, I would leave a moment for you guys to scan and really just to register for a demo account right now if you haven't done so. Right. Okay, so what I want to share again, after I share all this, I'll be talking a bit about what a full trading plan looks like. So don't leave just yet. Do stay tuned. What I want to share is that we have a Young Investors Telegram channel. So in there, we share a bit about we share snippets of bite-sized news to keep you updated on the market. So on a daily basis, we talk about indices. What are some things to look out for? We talk about cryptocurrency, and we have this segment called One Stop Before the Bell. We share with you a daily highlight of a particular counter that we picked, either from a US exchange, Singapore exchange, or Hong Kong exchange, just to give you an overview of what it is, what our views are, and more importantly, we share key information such as webinars, such as this, that are upcoming, live streams that are happening on our channel, what are some promotions and challenges that are coming up, and what are some campaigns we are doing. So the best way to remain informed is really by joining our Telegram channel. So go ahead once again, scan the QR code. You will be brought to the Telegram app where you can then join our channel. So we're glad to have you there. Okay, in this portion, I just want to share a bit about what we offer. So there are two key platforms here in Phillip Futures. So we do have Phillip MetaTrader 5 and we do have Phillip Nova, right? So what's the difference between them is that Phillip MetaTrader 5 primarily is a platform with Forex, metals, and CFDs. So in this session of CF Discovery, where we cover about the mechanics of CFDs and what we do offer, you can find them over at Phillip MetaTrader 5. Right, so the QR code is in the center for you to scan for an account opening. Right, so with this single QR code, you can either open a MT5 or a Phillip Nova. They are both under the same link. Right, so just some quick fun facts to share with you guys. In MT5, we offer over 500. We do offer 550 contracts and CFDs. All products over here is traded at zero commission. Now, if you are currently trading CFDs, you would know that for most brokers out there, there is a commission on shares, but we do not charge any commissions. We are purely based on spreads of the contract. So you can trade down to micro lots, especially when it comes to Forex, for shares as low as 1 share, even SGX shares and US shares. So a great thing about that is also there is no minimum commission when it comes to trading share CFD. So it is also integrated with key tools such as Trading Central. Now, for those of you who don't know what Trading Central is, it is a renowned trading tool system where it can give you things like chart patterns. It can give you things like analyst view, where on a day-to-day basis, based on the contracts that you select, they can give you what is the overview of that particular contract. And in MT5, we are also connected to renowned news providers like FX Street and Market Buzz. So now, moving over to Phillip Nova, really, who would want to open a Phillip Nova account? It would be for those of you who are interested in trading in stocks. So these are non-leveraged stocks that we are talking about here. So we offer about 8,500 of them, ranging in from US, Singapore, and Hong Kong markets. In this platform, it is also multi-asset where we do offer futures products and also FX products. Now, the cool thing about Phillip Nova is that we offer currently excluded investment products. What this means is that there are no additional certification required. Unlike for Forex trading over on MT5, you do need to meet the age requirement of 21 years old. You have to pass the CKA assessment. Right, over in Phillip Nova, if you just to open a purely stock account, that is not needed. Some advantages is that we do charge zero custody fee, and there is no platform fee at all. And in terms of SGX, we are the cheapest commission in town with no minimum commissions charged at all. So I do feel it is pretty relevant for young investors, especially if you're starting out with a smaller account size. You don't want your equity to be eroded by commissions, right? So a key thing that we have inbuilt in this is that really friendly to small account sizes. Right? We don't charge custody fee, we don't charge platform fee, and we don't charge minimum commission for SGX. So this will kind of give you a foray into what trading is about. Okay, if you wish to open an account, do scan the QR code. It will lead you to the account opening page. So just to share, you can actually open both accounts if you would like as well. Okay, now for the portion that you have been waiting for, what does a complete trading plan look like? So it comes in the form of a statement, but you track it using an Excel sheet, right? So for a complete trading plan, this comprises of the component we spoke about earlier, right? In combination of everything. Risk management, entry rule, exit rule, and also your post-trade management. So you can take a screenshot of this page. Take a picture of this page. By the end of the session, we are also going to send you an email within the next 3 days for the email that you used to register for this webinar. Right, so it looks like this. Put your own name, will only risk 1 to 2%. That's for you to decide, 1% or 2% or more. I mean, we don't recommend more of your account balance to enter either long or short trade with a risk reward ratio of 1.5 or 2. Again, that's up to you to determine on the shorter time frame, which is your entry time frame, say 4 hours. Or if you were to trade even lower on a time frame, 1 hour, right? When price on the higher time frame, which is either daily or 4 hours, is above or below the 200 exponential moving average, for example. So this will be your support. And so we have covered risk management. We have covered what the trend is. We have covered what the area of value is, right? So now we are going into confirmation triggers. So N has reached or is close to the key support resistance, and RSI is indicating either overbought or oversold condition. So this wraps up all the way from trend to area of buying and selling zones to confirmation trigger. Now, the final sentence really talks about your post-trade management. Once the trade moves X pips, or if you're trading CFD X dollars, X percentage, I will move my stop loss to break even. So this encapsulates really what a complete trading plan looks like and how you want to go about approaching trading. So it is hard work, right? Not only do you have to define what are these conditions are before you are willing to take a trade. What this means to say is also you need to put in some screen time to observe the charts, to look at it, and then to see which contracts meet your scenario, the scenario in which you have planned, and only then do you have the discipline to start trading. So this really sums up the lessons today, and indeed the 3 parts of all that we have covered. You have learned an introduction of CFDs, you have learned the mechanics of it, you have learned what are the risks to it, and today we talked about how do you manage it, how do you enter a trade from the perspective of technical analysis, right, by creating a trading plan. So I hope that this has summed it up for you nicely. And for any one of you who may have questions, I do understand today is quite a heavy session. We have covered quite a lot, and much of them are quite technical. So if you do have any questions, do feel free to reach out to us and post your questions, and we will be glad to help you out, to share with you whether or not your questions is pertaining to the platform, right? Navigating the platform, understanding the product for those of you who have missed session 1 and 2, or even how do you go about crafting your trading plan. So these are the things that we're happy to go through with you. And we have come to the end of this session. I do hope that you had a fruitful one, a good experience in learning the different things that we have covered. So with that, I just want to thank you. Thank you for taking time out your afternoon to be with us, and I hope to see you soon. So cheers and signing out.